So in my mind, if there is any push from Kevin Haslett, it will be much more along the lines of saying we need to get interest rates down quickly, okay, because that will help the real economy, it will help small businesses, it will give a signal to the forex markets, importantly, that we want the dollar to go down. It may help to get mortgage rates down, but I don't think necessarily keeping the Fed balance sheet bloated or high is on that agenda. Now, that clearly runs a risk, but it means that this is a policy, or the Fed policy that they're likely to run is not really a policy, in my view, that will sustain a strong bull market. I'm not going to say it's one that creates a bear market, but it's not one that really engenders a strong bull market.
For years, markets have been conditioned to believe that whenever growth slows or stress appears, central banks will step in with liquidity that lifts asset prices across the board. That assumption has become so deeply ingrained that many investors now equate easing with automatic bull markets. But that framework may be outdated, and dangerously so, as we head toward 2026. Michael Howell, widely regarded as the godfather of global liquidity and the founder of cross-border capital, is offering a far more nuanced and uncomfortable forecast. Yes, liquidity is likely to increase in 2026. Yes, policy will ease. But Howell's central argument is that the form of that easing matters far more than the headline numbers. Instead of a return to aggressive Federal Reserve balance sheet expansion, the kind of undirected liquidity that inflated financial assets and rewarded asset holders, Howell believes the next phase will be dominated by Treasury-driven liquidity, aimed squarely at supporting the real economy rather than financial markets. In Howell's framework, this shift fundamentally changes the outlook. Treasury QE, funded through short-dated bill issuance and targeted fiscal channels, may successfully stabilize growth, support small businesses, and strengthen economic activity. But it does not necessarily translate into strong equity or risk asset performance. In other words, the economy may improve while markets struggle to generate sustained upside, a scenario that directly challenges some of the most bullish narratives currently circulating. Before we dive deeper into Howell's liquidity forecast for 2026 and why he believes this coming easing cycle may disappoint markets, make sure to like the video, subscribe to the channel, and turn on notifications. We're breaking down the macro forces that actually move capital, not just the narratives everyone wants to believe. Let's get into it.
This orange line here on the chart, for those listening, is saying that in 2026, liquidity should go up.
Yeah, I think it's going to go. There's no question it's going to increase.
Right.
I think from here, I think the question we're debating is how much, and is it enough? Now, the issue that we raise is that it may not be enough. And the reason it may not be enough is shown on this following slide. Now, this is looking, if you like, at the other end of the pipeline. So the amount of money in money markets, in US money markets, is ultimately going to be reflected in the level of bank reserves. And the banks need a certain level of reserves to fulfill various criteria, such as things like the supplementary liquidity ratio, various other charges they've got. But ultimately, they are comfortable, or seem to be comfortable, with a level of reserves of around about 3.3 trillion. Now, that's the red dotted line on the chart. The orange line is the actual level of banks' reserves. Now, you can see that the orange line has fallen below that red dotted line projection. Okay. Now, I see no reason why that red dotted line should change dramatically over the next 12 months. Okay. Even given the various changes that the Fed has announced, such as changes to the SLR or whatever, I still think this is the sort of level that banks want. And we estimated that mathematically by looking at when you get stresses in the repo markets. And we basically felt that when the level of stress was eliminated, when there was no stress, that was the sort of level of reserves that the banks wanted. If the banks have deficient reserves, they've got to go out into the repo markets to bid for those reserves, or into the money markets to bid for those reserves. And that causes spikes in repo rates, as we've been seeing recently. Now, you can see the shortfall that we've currently got. The orange line has fallen well below the red dotted line. So as I said, we're around about 2.8, 2.9 trillion for US bank reserves. That's about 400 billion shy of where we should be. There is some liftoff over coming months because, as I said, there is likely to be a restart of a QE form of policy, and there's obviously the ending of QT. The question is, will that be enough? And you can see from the diagram, our expectation is it won't be enough. Now, we may be dancing on the head of a pin here to say, well, okay, perhaps with a little bit more oomph, we could get back there. The real question is that what the Treasury or the Fed really want to do? And I think that's the sort of $64,000 question here. And everything that I detect coming out of the Treasury and the Fed is they're kind of reluctant to add a lot more liquidity because, in the words of Scott Bessent, I mean, Wall Street's had its day now. It's enjoyed the fruits of very loose Fed policy, or the Fed dishing out lots of liquidity, and now it should be Main Street's turn. And so what I see is actually more of a shift away from Fed QE, much more towards Treasury QE. And I think a lot of the policies that are being announced, such as even changes to the SLR, the fact you've got funding at the front end of the market, maybe even the stablecoin phenomenon, all these features are basically lending themselves towards what I would call Treasury QE. And that is a much more directed form of liquidity stimulus that basically goes into the real economy and not, generally or in an undirected way to financial markets, lifting all asset prices, but creating big wealth anomalies in the economy.
I want to get your thoughts on how this new chair might play into this, because obviously, as we get into 2026, Scott Bessent, he will make a lot of these decisions. How do you think that changes the calculus in terms of what to expect from the Federal Reserve and their likelihood to meet the liquidity demands that we're seeing from the banking system right now?
Okay, well, I think the first thing to say is I don't think it's going to change it hugely, okay? Because we've got to remember the FOMC is a committee, and he is one vote, and Stephen Miran likely will not be there by the time he takes over. So I think that these are all considerations that one's got to throw in. At the moment, what you've got in the FOMC, if you start to look at who's voting, or the constituency of voting members, you've really got sort of three groups as far as I can see. You've got the group of those people that argue that you need more liquidity in the system. Well, let's say they're the more technical balance sheet, gurus. I mean, people like Laurie Logan at Dallas Fed, who used to run the SOMA accounts. I mean, she knows what she's talking about when it comes to understanding liquidity, the repo markets, and whatever. And she's been one of the people that's been pressing, as far as I detect, for more liquidity to go into the system. Okay, that's a small group, right? And she's not a voting member of the FOMC yet, although I think she may be next year. Although or not to quote me on that, but I think she may be. But that's really a constituency that's there that clearly has a voice, certainly in the debate. The second group are the more conventional central bankers. That's people like John Williams at the New York Fed. Also Jay Powell, obviously chairman. They're much more conventional central bankers, and they're really thinking in terms of more traditional metrics. Thinking of what's happening to inflation. How should they be setting interest rates? Going back to the old sort of methodology of Taylor rules or whatever it may be. They're, if you like, the old school central banker, and they're the ones that have really been dragging their feet over easing policy. I would say broadly over the last 12 months or so. And then you've got the Trumpites who have come in, and they're the ones who are very eager to cut interest rates. Now, I think the problem is that the baggage that they bring with them, and these are people like Governor Waller, I would put that, Michelle Bowman, also looking at Stephen Miran, but presumably the new Fed chair will be in that camp by all accounts, whoever he or she may be. But as you say, I mean, the odds are stacked anyway on one candidate. If you start to look at that grouping, they're saying they want much lower interest rates. I buy that, I understand that. But they're also saying they don't really want the balance sheet to expand very much. And that's a sort of anomaly that I can't quite get to grips with. But I think that's all consistent with this idea that you're moving from Fed QE, which is not a great thing in their mind, to Treasury QE, which is saying we're going to use the engine of the Treasury to stimulate the economy, and we're going to fund that through the bill market. And that's really, I think, the direction things are going in.
What Howell lays out next is the mechanical backbone of this thesis. Despite expectations for rising liquidity in 2026, the banking system is already operating below its comfort level for reserves. Even with QT ending and some form of easing returning, the shortfall may persist, forcing reliance on repo markets and revealing underlying fragility. The real debate, as Howell frames it, isn't whether liquidity increases, but whether policymakers are willing to add enough of the kind markets actually need. And that question leads directly into the policy shift that defines his outlook.
So in my mind, if there is any push from Kevin Haslett, it will be much more along the lines of saying we need to get interest rates down quickly, because that will help the real economy. It will help small businesses. It will give a signal to the forex markets, importantly, that we want the dollar to go down. It may help to get mortgage rates down. So all these factors are, I think, in their sights when it comes to trying to understand the policy direction. But I don't think necessarily keeping the Fed balance sheet bloated or high is on that agenda. Now, that clearly runs a risk, but it means that this is a policy, or the Fed policy that they're likely to run is not really a policy, in my view, that will sustain a strong bull market. I'm not going to say it's one that creates a bear market, but it's not one that really engenders a strong bull market. And that's really, I think, the concern. It may well be a policy, or it may well be a strategy that is good for the real economy. And actually, I'm pretty upbeat on the US economy for next year. So this is looking at a plot of Fed liquidity in red. So this is the estimate that we put together, which is basically looking at the liquidity creating elements of the balance sheet. And this is an absolute dollars. So you see on the right-hand scale, this is hovering around three and a bit trillion. That's the red line. That's the projection we make into 26 based on the evidence that I just gave you. The orange line is the S&P. Now, if you look back, and what I've done actually, I should stress here, is that the S&P has been lagged by 25 weeks to show that liquidity is a key leading indicator. It doesn't get every twist and turn in the markets, but if you just look back, often where you get big air pockets in Fed liquidity, the market comes off, and it's a lead indicator because you've got that 6-month lead time. Now, what this is saying right now is that the fall in the red line that you've had, which is the TGA rebuild, is ominous when it comes to looking at what the S&P may be doing. And that's one of the reasons that we're, let's say, cautious about markets right now, because you've actually seen this absolute fall in Fed liquidity, and historically that's not good, okay? It's going to rise next year, but this is a little bit of a belly flop when it comes to, looking at the potential for 26. You're not really, rebounding very strongly to where we came from. And that's really the danger. If you look at the following slide, what that basically shows is Fed and Treasury stimulus. Now, this is looking at all forms of liquidity stimulus. And this highlights the fact that what we've got on the page is a diminishing Fed component and a rising Treasury component. Now, let me just walk through those various elements. The red area on the chart, so this is the amount of liquidity stimulus, and I'll explain in a little bit more detail how we get the Treasury one. But the red is straightforward QE by the Fed. So that's old-fashioned, plain vanilla QE. The Fed is buying bonds, right? The orange element is what I called and mentioned earlier, is not QE. That is the backdoor channels. So this is things like the Bank Term Funding Program. It's things like changes in the RRP, the TGA, operating losses of the Fed, etc. Everything put together in that orange band. And then the Treasury QE is basically the black area. Now, what that measures is the effect of changes in the duration, in other words, the average maturity, let's say, of the outstanding stock of debt held by the private sector. And the reason for looking at this is that if you think conceptually about liquidity, what liquidity is the size of an asset pool divided by its average duration. Now, that sounds a bit wonkish, but But if you think about it, that's broadly what liquidity is. So you can get an increase in liquidity if you increase the amount of assets in the system, or if you reduce the duration of those assets. And that's effectively what the Treasury is doing by doing a lot of spending through the bill markets. So bills are clearly very, very short-dated debt. And if they're not issuing, 10, 20, 30-year treasuries, but they're actually issuing 3-month bills, then there's a complete change in the average maturity of the debt structure of the US government. And that is starving the private sector of duration, but it means that there's more liquidity in the system notionally. And that's the black area. So what you see here is the big increase in Treasury bill issuance is actually causes like a liquidity injection. And you can look at it another way and say, well, that's actually the banks are monetizing that. But, effectively, we've got this liquidity shot in the arm coming from the Treasury. The difference between Fed QE and Treasury QE is that Fed QE is undirected. Okay, it's just thrown into the money markets or the financial markets, and asset prices find their level. And you hope that you get some spillover into the real economy, although clearly that's not guaranteed. Whereas with Treasury QE, it's much more directed. Now, what I tried to show is that if you look historically on that little window, the black line is the change in the US PMI, the aggregate PMI, over 12 months. And I've lagged that by 9 months. And I've plotted it on top of this combined stimulus, the same graph, in fact, you see there. Now, what you can see is that the liquidity stimulus pretty much traces out the business cycle. So, if anyone's concerned about a dip in the economy right now, you could argue it was kind of expected because that the liquidity stimulus came off last year, and therefore you'd expect some sort of dip following in 25, which maybe we're getting. But as you look at that orange line, it's ramping up again, and that would suggest that the economy is going to be stronger in 2026. That's how that would be our assessment, at least, and that's the impact. Treasury.
What I'm seeing here is that you're forecasting that the ISM should pick up in 2026, which would reflect a bullish momentum from the actual economy. But then I'm also hearing you saying, like in the prior slide, that you're expecting that asset prices may not follow that bullish momentum.
I think that's right. Strong economies don't always have strong financial markets. And the fact is that, you think of it this way, all money that is anywhere must be somewhere. If it's in financial markets, it's not in the real economy. And if it's in the real economy, it's not in the financial markets. Unless, of course, the Federal Reserve is just pumping money willy-nilly, and we know it's not.
At the core of Howell's analysis is a distinction most investors still underestimate: Fed QE versus Treasury QE. Traditional Fed QE injects liquidity directly into financial markets, suppresses yields, and lifts asset prices almost mechanically. Treasury QE, by contrast, works through fiscal channels, shortening the duration of government debt, expanding bill issuance, and directing liquidity into economic activity rather than speculative markets. Howell's data shows this shift clearly: a diminishing Fed contribution and a rising Treasury role in overall liquidity stimulus. This is why Howell is cautious on markets even as he remains relatively upbeat on the U.S. economy. His models show that Fed liquidity acts as a leading indicator for asset prices, with declines often preceding market drawdowns by months. While liquidity is expected to rise again in 2026, it does so from a lower base and without the aggressive rebound that historically fuels strong bull markets. The result, in Howell's view, is an environment where growth stabilizes, business activity improves, but financial assets fail to deliver the upside many investors are positioning for. That outlook stands in sharp contrast to analysts like Raoul Pal, who argue that a synchronized global easing cycle will drive powerful risk asset rallies. Importantly, both views share common ground. Liquidity matters, easing is coming, and macro forces will dominate returns. The divergence lies in where that liquidity flows. Pal expects it to find its way into markets. Howell believes it will be absorbed by the real economy, leaving asset prices comparatively starved. This divergence raises a critical question for Bitcoin and crypto. If Howell is right, and financial markets no longer receive undirected liquidity support, correlations could finally begin to break down. Bitcoin's long-term thesis as a monetary asset may benefit from declining confidence in traditional financial engineering, even if equities struggle. Crypto may not surge simply because liquidity is rising, but because capital starts searching for alternatives outside the conventional asset hierarchy. If you found this breakdown useful, hit the like button, subscribe for more serious macro and crypto analysis. I want to wish you a focused, disciplined, and successful new year ahead. 2026 is shaping up to reward preparation over prediction, and this channel will be here to help you stay ahead of the curve. Thank you for watching, and I'll see you in the next one.